All right, so my name is Jack Bruton. I'm with the CPMS Client Services team. I'm going to take you through the USA side of things now. So as Ryan said at the beginning, please, if you do have any new or interesting ideas, any additional content that we can provide, please send us an email right here at cacpmssupport@morningstar.com. We're always looking for additional content or interesting ideas. So to make this better and more relevant. We're going to follow a similar structure to what we've done on the Canadian side and also just in the past. So we'll start things off by going over the market performance, take a little bit of a look at the best sectors and stocks, then take a little bit of a quant dive, doing a single factor analysis and look at our overall model performance. And then we'll finish things off with market fundamentals and general outlook. Okay, so we could see the S&P 500 2020 Q1 from a price return perspective, so not including the reinvestment of dividends, it was a tough quarter. It was down 20%, and that's obviously due to the COVID-19 and also the price of oil and the oil war, so a bit of a double whammy there. You could see that the steepest decline was in March, and we were down 12.5%. Now we're going to be taking a look at the total return of Q1 in the US. So that is including the reinvestment of dividends. So we can see the S&P 500 was down 19.6%. The Russell 2000, so that's going to be small cap names, was down the most. That was down 30.61%, which, I mean, it's not really that surprising because small cap names, they do tend to be more volatile, sometimes more volatile to the upside. Which we like to see, which is great. But unfortunately, in this case, they were a little bit more volatile to the downside. And then we could see the NASDAQ, the tech-heavy NASDAQ, being down only 13.95%. And actually, you can go over to January. It's the only positive number within this whole entire slide that was actually positive. Here, we're going to be looking at market breadth. So this is the number of stocks with a positive total return. So just to give you a sort of rationale as to how I calculate this number, I don't care if the stock is up 0.001% or 100%. All I care is the fact that it's positive. And then I take the number of positive stocks that had a positive return, and then I divide it by the number of stocks within that index, whether it be the 500, the 400, or the 600. And we could see market breadth over Q1 was terrible, right? 500 had 6%, 400 5%, and the 600 was 6%. And it's actually the worst quarterly U.S. market breadth that we've seen in the past 26 years. This is just a historical sort of outlook for the quarterly market breadth that we've had in the past. You can see 2019, right? It's pretty much on par with 2008. So you can see sort of that's the type of sort of trouble that these markets are in. And also, if you want to take a look even further, we could see down in 2001 as well. Here, we're going to take a look at the Q1 total returns, but from a sector-by-sector perspective. Energy obviously had a pretty rough quarter. It's down 50.45% with 0% breadth. Also, IT was the best performing sector, is negative 11.93. And also utilities was down 13.50 with another 0% breadth. With the S&P 500, of course, finishing down 19.6. If we move over to the right side, we'll take a look at some of the best performers right now. So in terms of the best performers, you can see under materials, Newmount Corporation is up 5%. We actually purchased that in the Canadian and US dividend growth strategies. So that's done quite well for us. So we're happy about that buy. Amazon, no surprise there. That's up 6%. Everybody working from home, there's going to be not going out under quarantine. There's going to be increased amount of shippings and delivering at home. See Clorox under consumer staples, cleaning company, obviously cleaning, sanitizing, very important now. See Regeneron Pharma in the healthcare sector, it was up 30% and actually the top performer for the quarter. I'll touch on that stock in a couple slides from now. Going down, also Citrix. I know that some of you are actually using Citrix to remote in, use the VPN. I've had to deal with a few problems there personally. And then finally, Netflix, right? That's been my savior in terms of fighting the boredom. So that's done well, increasing the user base. And now we'll go over to the worst performers. We see, obviously, United Airline Holding in Norwegian Cruise Lines. Nobody's flying anywhere, and also nobody's taking any cruises. Well, some people are, but I wouldn't advise it. And then finally, we got minus 82% with Apache Corp as the worst overall, pardon me, performer. Here, this is just a visual representation of the previous slide as to how the sectors performed. And now we're going to talk a little bit about Regeneron. So Regeneron was the top performer within the S&P 500. And you can see here, the Regeneron daily close is in red, S&P 500 is in green. So you just sort of put them against each other in this chart. And the reason why Regeneron did well is because they potentially are developing a vaccine or a treatment to fight COVID-19. So back in, so Regeneron has partnered with Sanofi, and they actually created a drug back in 2017 called Kevzara, and it actually fights rheumatoid arthritis. And what it does, it inhibits, I guess it blocks signals that cause inflammation for rheumatoid arthritis patients. And what they're testing this out on is they're seeing if this Kevzara drug can actually try to block the receptors from causing lungs to be inflamed in COVID-19 patients. So obviously that fueled the share price. The market really liked that. I believe it's up another $100 from this point right here. And yeah, we obviously all hope that that works. And how does Regeneron Pharmaceuticals place in our strategies? All right, so we can go through here. So we have the rank and status here. So it's currently a buy in 1, 2, 3, 4. In a few of our strategies here, right? So a buy means that it meets all of our buy criteria. A hold means that it's breaking one or more of our buy rules, but it hasn't broken a sell rule, so we're not going to sell it. It's just a hold. And a sell obviously means it's breaking one of the sell rules. And if it's highlighted in yellow, it means that we actually own it within these portfolios. So I like to do this, and I like to see, it kind of gives you a little bit of, it tells you a little bit about the stock, like what type of stock is it. So we could see here, we see earnings momentum, momentum breakout, price momentum, earnings momentum 10, right? So I think the key theme there is the fact I see it in every single holding, it's momentum, right? So it's a little bit earnings and price momentum based, right? So it gives you just a little bit more of a story there. And here is the S&P 500 metric change. So I know that this is a quarterly review, and we do tend to focus only on the quarter. But I thought, just given the fact that it was a crazy quarter, I wanted to open it up a little bit. And I was really interested to see how various metrics changed. So what I did was, in this first column here, you could see this is the S&P 500 as of November 18th. And that is when the first known coronavirus case was reported. And then I wanted to compare it to the bottom of the market, which was March 23rd in this second column. And then I wanted to see what it was like sort of when I was making this deck, so April 17th. So, from November 18th, so the first known, to the market bottom, we could see that estimate revisions were slashed from -1.8 to 5.9. We saw deep cuts in valuations, right? You could see all these like trailing PE dropping, all these things, and yield getting a nice bump up to 2.6, just given the market decline. And current year EPS growth was actually 1.8, so it's at that point, I mean, not so bad. But fast forward to April 17th, from the bottom of the market to now, right? You can see, yield is now at 2%, and that's mainly due to dividend cuts, suspensions, and also, just the general market rally or bounce back, I should say. But what really caught my eye and I thought was super interesting was this estimate revisions number here. So it's -20.2. So originally, from the 18th to the 23rd, they only revised down just a little bit, right? But now they've revised down significantly, down to -20.2%. So it just goes to show you how sort of, how slow analysts have been to sort of process all the information, right? And sort of come up with a recommendation in terms of their estimates, right? We're now looking at current year EPS growth coming in at -13.6. It was positive, now it's negative, so everybody's being a lot more, they're revising downwards. And the PECYM variable is now 20.8 from 18 at the beginning. Okay, here is another new slide here. So this is the top 15 stocks trading at a discount. This is from our analyst team out in Chicago. So they assigned fair value estimates based on all their projections. They plug it into a DCF and it gives you essentially a number. It's a lot more complex than that, but on a high level, that's what it is. And if you do want more information on that, on how they derive these fair value estimates, please click this link down here, and it'll take you right to our methodology report. So the reason why I'm including this is, as I said in the Canadian side when I was presenting this slide, I think it's a stock picker's market, and I think that there's pockets of value all over, and I think that our methodology and how we select these is rock solid. And the way on a high level, we are value driven long-term investors, right? And we invest in good businesses that have an economic moat. We'll talk about that later over on this right here. Yeah, so the MS fair value variable, this is our fair value estimate for the stock. This is the PR now is the price now. This RMS fair is it's the potential upside, so 411% potential upside for Viacom CBS. And then now I'll start talking about these MS moats, right? So when we assign a moat, it's either a no moat, a narrow moat, or a wide moat. So 3 would be narrow, 5 would be wide, and 0 is no moat, with 5 being the widest, and that's what we want, right? And we look at these and we analyze moats. It's a very Buffett-esque term that you've probably heard, and it's just picking stocks that really have good businesses and could fend off competition. And we examined 5 factors when assigning these moats here. So the first one being intangible assets. So do they have any brands, patents, or is government protecting them potentially? Cost advantage, can they sell their products at a cheaper price than their competitors? Switching costs, is it a major pain to switch from one competitor to another? If the switching cost is high, I may be more inclined to just stay the course or stay the status quo as opposed to switching over. Network effect, I'll say this again, it's probably I think it's the strongest. So the network effect, it's the value of a particular good or service when it actually increases for new and existing users as more people use that service. And it just creates a cycle that allows companies to become even stronger. Expedia and also Facebook are some examples. So I'll say the Facebook example again for people that are only listening to the US side. So imagine I have a group of friends that are on Facebook and I'm currently not on Facebook, right? So if I want to have contact with them and connect with them, I need to register to Facebook, and that's good for Facebook because it's more users and more ad revenue hitting more people, right? Now, let's just say once I'm on Facebook, I have another group of friends that want to get in contact with me, right? So the easiest way for them to contact me, let's just say, is through Facebook. So they'll all join, and it really creates this vicious cycle that goes around and around and just really helps companies become strong. And finally, we have efficient scale. So efficient scale is just economics. It's really it's an industry or sub-industry is really effectively managed and taken care of by one or more companies, or just a few companies, and other competitors are deterred to enter because if they were to enter, it would become unprofitable for everybody. And then MS star, 5 being the best, 1 being the worst, or it's basically a 5 means that it's the largest risk-adjusted return to fair value. So that's what you want to see. So you want to be looking in this list. You want to be looking at stocks that have a moat, have a high star rating, right, and are undervalued. And all of these factors are available in CPMS, and I would encourage you all to. I think that they're very overlooked, and I would encourage you to look at them. Just take a look. Here we just plotted the S&P 500 versus the price of oil. Obviously, price of oil a lot lower, especially today, right? And now we're going to take a look at the Q1's best and Q1's worst performing stocks, top 50 in the S&P 500. So here we go. We could see Newmount Corporation up 4.5%. So that's the one we bought in the Canadian US dividend growth. So that's great. Amazon did well, up 5.5%. Something that caught my eye here that I didn't really expect was Tiffany's did quite well. So, the reason why I say it caught my eye is, with everybody being laid off and not working, I didn't think that people would be, I didn't think that they'd have, people wouldn't be spending money on diamond rings. Go down to consumer staples, see Clorox doing very well, and also all the other like food and grocery companies, right? Which you'd expect. Healthcare, a lot of names in healthcare have done quite well. It does tend to be a pretty defensive in terms of the U.S. market. Absolutely not in the Canadian side of things, just because it's just all the cannabis names. Information technology, you could see some names here: Citrix, Microsoft, right? Communication services. We have Netflix, Activision Blizzard. It's a video game company. So that's they've all done well, right? In terms of the worst, we could see energy, right? No surprise there. So industrials taking a look, you know, a lot of airlines, right? And also consumer discretionary, you know, the subsector consumer discretionary, you know, like travel and leisure is just, it's done poorly, obviously, especially with, you know, people not having as much disposable income. They're not going to spend their money on discretionary goods. Here we have the QN's best and worst performing stocks, right, in terms of the attribution. So we've taken the top 50 on that previous slide and the bottom 50, and we've taken a look to see what they look like at the beginning of January, on January 2nd, at the beginning of the quarter, just to see, you know, what type of, you could sort of see what type of market it is, right? Keep in mind, this first column here is the S&P 500. This here is the actual portfolio, equal weights, the top 50. This is how it performs relative to the benchmark, and this is the top. This is the bottom 50, so this is the portfolio, and then this is the relative here. So you could see, you know, from these top 50 stocks, the best ones, you know, they tend to be, you know, fairly valued. If you look right here, it's just a little bit overvalued, but I'll call it fairly valued. They tended to be lower beta stocks and also have a lower yield as well. And if we go over to the bottom 50, they're heavily undervalued on every single metric, and tended to have a higher yield, and also just poor growth metrics across the board here. So this is our historically how Q2 has done. So we go through all of our data, and historically Q2 has returned on average 2.8%, has a median return of 2.6, a standard deviation of 7, and it actually tends to be positive 76% of the time. Here we do the exact same thing with the GIC sector. So we could see utilities produce the highest return, not only in Q2, the very low standard deviation, 7%. Healthcare is not too far behind. Now we're going to take a little bit of a quant dive. We're going to see which factors were rewarded or punished during the quarter. So the way that we do this is we say, okay, we're going to take the top 50 names. We're going to assign a weight of 1 or a DOI of 1, and just say we're going to buy these 50 names. And what would happen if we didn't buy or sell anything? If we bought them at the start of the quarter and just held them to the end. So you can see here, so anything above this red line beat the market, which was, I believe, is 19.6, right? So you could see, quarterly sales momentum did well, and I believe that was one of the factors that the top 50 best had. And also, if you go down here again, on the Canadian side, just yield being punished, which was very surprising to me. Again, you know, in the decreasing interest rate environment, I would think that these higher yielding stocks are getting bought up, but apparently not. And also, you can see all these price to book, price to cash flow, all these valuation metrics, right? That the 50 worst had. They're right here at the bottom. So it really doesn't appear that we are in a value sort of market right now, but I could be wrong. This is just an observation. And we're going to take a look at the style analysis here. So anything above this S&P 500 total return, obviously it performed better. So the large cap D10 income asset growth did quite well. So on the asset growth side, we're looking at, we have weights on reinvestment rates, estimate revisions, and price changes. On the income side of things, we have market cap, estimate revisions, and yield. But it's industry relative yield as opposed to just I guess, yield that we use on the Canadian side. And you can see the industry relative also did quite well. So very interesting. And then again, down at the bottom, you see the valuation and all these values sort of things doing not well. So it just goes to show and sort of like reiterate the point that we may not be, that value still might be out of favor. But at some point, its value will rise, but who knows? Now we're going to do a market fundamentals and just a general outlook. So here we could see that the median ROE has been stable, but it is expected to decrease. You can see right here the estimate, which does not happen often. I've never really seen that. Normally it's an increase, but it's unprecedented times, right? And now we're going to see earnings. Earnings are expected to decrease to next quarter. Estimates, you can see right here, they're being slashed significantly. The earnings surprise, we'll have to wait and see. It's a little bit of a lagging indicator, so we'll wait and see next quarter here. And just general sort of economic outlook, we can see the unemployment has increased to around the unemployment has increased to 4.4%, and we would expect that to increase. We're going to take a look at some of these sectors, and the GICS perspective, we see energy being very cheap again. You know, that's sort of been the case for a while now, with estimates of energy being slashed negative 53.8%. Going down that list, everything across the board is in the red for estimate revisions for expected negative EPS growth on negative 37.3%. Some other cheap sectors from a price book perspective, financials. It's also very cheap. I don't know what it was last quarter, but I assume it was higher. And it kind of makes sense. So if you think about what's happened, right, and the way financial companies make their money, majority of it, so they make it through two ways. So that's going to be interest rates, like they manage the spread, and also asset prices. And both of those have tanked. So no surprise that we see a little bit of a cheap valuation from that sector there. Here we have the beats and misses of the S&P 500. So overall, we have 71% beat the S&P 500, 26% miss, 3% met. We have financials beating 73%, communications 77%, energy 52% missed. And then IT still continuing to do well, 87% beat.